Hello, I'm here today to talk about Challenger Financial Services, which to us is still one of the standout stocks in the financial services space. The recent bank reporting season just highlighted how difficult growth is to find in the financial services sector, and we think on that basis that Challenger remains a standout. We have the view that Challenger can grow its earnings at high single-digit levels for the foreseeable future, which compares to the banks, which are growing their earnings sort of closer to 5% across the board. The reason we like Challenger is its huge sales growth. If you look back over the last 4 years, on average, Challenger's grown its retail annuity sales by 30%, which is just a huge number. The last company to grow their sales at that sort of level was Tower, which was bought by Dai-ichi Life at a huge premium several years back. So that growth profile is very, very strong. The other thing we like about Challenger is they've also got other avenues to grow their sales that they're only starting to explore right now. If you look at sort of platform sales, very small part of their sales components at the moment, but they recently got added to the Colonial First State platform, which is obviously the biggest platform in Australia, and there's going to be numerous other sort of industry funds that are going to add Challenger onto their platforms in the next 6 to 12 months. So we think that's going to provide good sales momentum. If you also look at the recent financial services inquiry, it was very, very favourable on retirement incomes and the need for products in that space. We think that's eventually going to see the changes of tax treatments in relation to deferred annuities, which will again give Challenger another area in which they can sell their products or create a new product in the deferred annuity space, which again will help drive further sales momentum, which is on the back of sort of the baby boomer retirement phase, which is occurring in Australia. The other thing we like about the stock is, very strong balance sheet. Got 1.1 billion of excess capital. They've raised significant capital for the new capital requirements that APRA has put on them, and they're well past needing to raise much more capital in our view overall. They've also done very well to hold their life margins at around 4.5%, despite a very, very low interest rate environment. And I think that's impressed the market, their ability to hold margins and meet guidance, even though they are facing sort of headwinds in that particular space. Their funds management business, if you look, it is now a bigger funds management business than Perpetual. It's got over 27 billion in FUM, and the market still doesn't give Challenger huge credit for their funds management business, and we see that as an area of upside. They're basically getting or have been getting 5 billion or so in net fund flows a year, which is very strong fund flow momentum, and at some point we think that funds management business will get scale and continue to provide earnings growth outside of the life business. If you look at Challenger, where it's trading on about 14 times PE, so it has re-rated from sort of closer to 11 or 12 times, but we still don't see that multiple as highly demanding. The stock's also offering a 4% yield, and they're only doing a 50% dividend payout ratio. We think over time they'll hopefully can lift that payout ratio, and they're now offering full franking on their dividends, so it's not an unattractive yield given the growth profile of the stock overall. But as I said, versus the insurers, versus the banks, this stock has clearly the best growth profile across the space. The retirement income generation or baby boomers could mean it's got 20 or 30 years of solid growth. And we think ultimately if they can continue to deliver, apart from the organic upside in the stock, we think it will become an attractive target longer term for the banks, etc., which are obviously looking for new areas to grow. So it remains our key pick in the financial services space. Outside of that, we continue to like ANZ, and the other stock that we have a buy on in the space is QBE, which we think is on track for a good second half result.